The broadcast is now starting. All attendees are in listen-only mode.
Hi everyone, welcome. We're now ready to begin our webinar, ESOPs as a Succession Planning and Wealth Creation Tool for Business Owners. Next slide. John, next slide, thank you. I'm Virginia with Rutgers School of Management and Labor Relations, and I'm your host and moderator. The Rutgers, New Jersey, New York Center for Employee Ownership is the proud sponsor of today's webinar, and we're very excited to include this topic in our webinar series. We have allotted 45 minutes for this presentation. Next slide. We encourage everyone to send us your questions. To do so, you will click on the orange arrow. You will type your questions into the question box and press send. We will be taking questions throughout the webinar. Next slide. This webinar is being recorded and a link to the archive version will be sent to you by email by early next week. Next slide. It's now my pleasure to introduce our instructor. John Vitucci is a principal in the Employee Benefits Services practice at PKF O'Connor Davies and has more than 30 years of experience working with Fortune 500 corporations and investment banks in all areas of employee benefits, executive compensation, and ERISA. John frequently speaks at industry seminars on employee benefits. He publishes many articles and is regularly quoted in publications, including the Wall Street Journal. Additionally, John sits on the advisory board of the Rutgers, New Jersey, New York Center for Employee Ownership. John, please take it away.
Okay, thank you, Virginia. Good afternoon, everyone. So today what we're going to talk about is we're going to focus on ESOPs, obviously. We're going to start off with retirement plan optimization, go through some succession planning considerations. We're going to discuss the ESOP opportunity, give you a flavor of ESOP transaction steps and the advisors that are involved with an ESOP. And we'll be able to take some questions and answers, but please feel free to if you have a question during the presentation, I don't mind stopping and to answer a question as we go. We'll also open up at the end to answer some questions as well. So, a lot of people ask, what is the optimal size of a company to consider an ESOP? And it really depends on, your business. But what we've put up here is some general rules of thumb as when it makes sense to do a 401k plan, a defined benefit plan, or an ESOP. And, quite honestly, if you have a single owner of a business and we call it EBITDA, earnings before income tax and depreciation, if you're below $1 million, it probably makes sense just to have a 401k. If you're between $1 million and $2 million of earnings, it probably makes sense to have a 401k and a defined benefit plan because a defined benefit plan can benefit the business owner substantially. And then what we find, because of implementation cost, that an ESOP is more clear-cut to make sense for a business owner, say, with earnings of $2 million or more. And I generally find that the criteria is at least 15 employees, a profitable business of $2 million or more, and a taxpayer, because a lot of the benefits of an ESOP are driven by taxes. So, if you have earnings above $2 million, it probably makes sense to have a 401k, a pension plan, and an ESOP. And, we're not going to get really into defined benefit plans on this presentation. So kind of the next step here is kind of talking about, what is the risk to a private business? And, if you look at public companies, my understanding is in the last 15 years, we've had about a 50% turnover in public companies. So, you have the Amazons of the world that are causing a lot of disruptive innovation. And so there's a lot of risk in public, and there's probably as much risk, if not more, in private business. So you have political competition, you have disruptive technologies that are constantly coming in, you have employee issues, key people leaving. A lot of times the private business, the key owner is the business. So there's a lot of risk, and monetizing that value of the private business is very important. And what we find is that private business owners, a lot of times they wait to the last minute to sell their business, and unfortunately, what could happen is they could pass away or get sick, and the business loses a lot of value, and there's no second layer of management to take over a business. So an ESOP is really a very good solution for businesses that may not easily be sold. So, why are business owners not liquid? Well, a lot of them, 80% of their wealth is in the business, and a lot of times the business owner has a lack of knowledge of possibilities or getting bad advice. They just don't want to face succession planning. You have inertia. Many times there's no second level of management to turn over the business to. And then the seller or the key employee is the business. So an ESOP is a great way of transitioning to a new management team. So one of the things I like to talk about is, as far as disruption, the business market right now is constantly being changed, whether it be technology, outsourcing, you name it. There's so many things going on, but these are some interesting statistics. The one interesting statistic is that the average student will have 10 to 14 jobs before age 40. And, many years ago, many people would stay in the same job for 30 years, and we have a very different market right now. The other fascinating statistic is that, baby boomers are retiring at the rate of 1 every 9 seconds right now. So those are pretty fascinating statistics. And what's even more fascinating is that the children entering school, most of them entering school, the job that they're going to work in, 65% of those people, that job doesn't exist right now. So things are really, really changing quite quickly. And, an ESOP is a good way to protect and monetize the business. And it's also a great way to help employees increase wealth substantially. So before you could talk about an ESOP, you really have to think about what are the other alternatives for a business owner. So, there's a number of ways to monetize a business. A lot of businesses do what's called a leveraged recapitalization, whereby they just borrow as much money to take it out of the business as they can. The problem is the business isn't sold, and there really aren't tax benefits of doing such a structure. And generally speaking, a business can borrow maybe between 2.5 to 3.5 times earnings. So it's not a very efficient way to get cash out of the business. So when you look at how do I create monetization, first, certainly you have what's called a leverage recapitalization. The other way is to just sell the business to a third party. The problem is a lot of businesses, particularly in the small business area, may not be sellable, or they may not be, a buyer that's willing to buy a business at a high valuation. And an ESOP, is certainly something that can be used to buy a business, but an ESOP still has to buy at fair market value. You don't have an ESOP buying above what a third party would buy. But the truth of the matter is there may not be third parties to buy a particular business. And also the business owner can be a substantial part of that business. So, no matter what, even if you sell to a third party, the business owner has to be materially involved. if there's no succession plan or a management team that can run the business. The other approach that people look at is using a book value approach. And what a book value approach is that you create a value for the equity, but it may not be the fair market value of equity. And this is commonly used by professional service firms such as accounting firms, engineers, and other professional entities such as law firms. The issue with a book value approach, it's not fair market value. People are not getting the value for their equity at fair value. And again, you don't have favorable tax treatment. So, which then goes to, if it doesn't make sense to do a leverage recapitalization, or it's not optimal to sell to a third party, or the book value doesn't work for you, the ESOP is really the next best solution. Now, there's two approaches of using an ESOP. The first approach, an ESOP is an employee stock ownership plan, and the first approach is if you have a corporation and you sell at least 30% of the business to an ESOP, the seller, if they buy what's called replacement property, which is any domestic stock or bond, within 12 months of the sale to an ESOP, they can defer the gain on the sale. The challenge with doing a tax-free sale to an ESOP is that you have to take the money and buy replacement property, whether it be for 30% of the company or 100% of the company. The challenge I find with that approach is that you're creating a lot of debt at the company level. If you want to get some monetization, and you don't want to pay taxes, then you have to maybe buy those securities on margin. And then you are buying securities, whether it be equity or debt. So when I look at a tax-free sale approach, that approach can be optimal. And we usually find this works well if the business owner is pretty old. Maybe over age 70 is when I really see this. Although you will see it quite a bit for people below 70. But again, what you're doing is you're trading off, you're diversifying out of your business, but you are creating other risks: leverage on the business, leverage on the replacement property, and you also have investment risk with the ultimate investments that go in. The other approach is just to do a taxable sale to an ESOP, and in that instance, the business owner participates in the ESOP. So the beauty about the taxable sale to the ESOP is that you're actually selling the company. Okay, there is a monetization event. There is some seller notes that are because it's hard to sell 100% to an ESOP because you have to come up with the equity. But the beauty about the taxable sale to an ESOP is the business owner can participate in the ESOP, where in a tax-free sale, they're not allowed to participate in the ESOP. They can get what's called warrants in the business, which is equity in the tax-free sale. So I tend to see more taxable sales to ESOPs than tax-free sales to an ESOP using what's called a deferral of gain approach. So let's just kind of play off the taxable sale to an ESOP. One of the beauties about an ESOP, in 1998, Congress changed the law that basically said that if an ESOP owns an S corporation, and if it's 100% owner of the S corporation, the S corporation won't have to pay taxes at the federal level. And many states have adopted this as well: New Jersey, New York, Connecticut. So many states, probably most of the 50 states, basically at the state level, you don't have taxation. Now, one note is that New York City doesn't recognize S corporations, so there would be an 8% tax in New York City. It's one of the few locales that don't offer favorable tax treatment to ESOPs. But we've done a lot of New York City ESOPs anyway, because if you live in New Jersey or New York, most business owners are in the 50 plus tax rate if you take federal and state rates. So even in New York City, you're talking about reducing from 50% plus tax rate to a maybe an 8% rate, and that's a substantial difference. So let me walk through a little example for you, because it's easier to understand the value of the ESOP if you sell to an ESOP. So quite simply, let's just say we have a company that earns about $10 million a year. So that company, the business owner of that company, would be paying $5 million a year in taxes on the $10 million. If that person were just to do what I call sell to an ESOP 100% and take back a note that pays over 10 years, a 10-year seller note. So with a 10-year seller note, let's just say that we pay $5 million a year in principal and interest, principal, and there's an interest rate on it of let's just say the principal's $5 million a year, and over 10 years that's $50 million. So the beauty about selling to the ESOP is now that the company stops paying taxes. So the $5 million that was going to the government now can be used to buy out the business owner. And so the business owner gets monetized over the 10-year period, and the business is tax-free. Once the business owner completely gets their $50 million, now you've got a company that was earning $10 million a year, that's worth $50 million. And so basically just $10 million of cash starts building up in the company. And that provides incredible benefits to the shareholders, the former shareholder anyway, who's participating in the ESOP, management, and to employees. And in many cases, when you set a structure up like this, the former owner or owners can have a material stake in the ESOP, so they can get a material benefit. And I call it the second sale. So the beauty about doing the ESOP for the business owner is they sell the business today, and then they get a chance to sell the business again down the road. So it's a wonderful way to create value for the business owner and create significant wealth for management and employees. So an ESOP is a wonderful succession planning tool. So if you could either do it with seller notes, or you could bring bank financing, where a bank finances part of the transaction. So in my example of a company that may be worth $50 million with earnings of $10 million, you might be able to get bank financing between $25 and $50 million of that, and then the difference would be either a $25 million or a $15 million seller note. A lot of our clients that go forward with an ESOP try to get some bank financing, unless it's a very volatile business where the earnings of the business fluctuate. Then it may not make sense to do bank financing. It might make just sense to use seller notes. The other good thing about structuring the ESOP is that the earnings, the cash that builds up in the company that may get distributed to the ESOP, kind of creates a bankruptcy protection vehicle. So let's say we run out after 5 or 10 years, pay off the debt on the company, and the company's still continuing to earn $10 million a year. That $10 million a year will now can get transferred into the ESOP, and so you're diversifying because now you have cash moving from the company to the ESOP. So people say to me, so John, what is the biggest challenge of an ESOP? And quite honestly, the biggest challenge of an ESOP is that there's so much wealth creation. and you need to, what we find is if a company's worth $50 million today, if the company just grows by 4%, what we find is a $50 million company with an ESOP in 10 years could be worth $100 million. If the company has great growth rate, it could have even a greater level of wealth creation. It could be worth $150 million in 10 years. Let's say they have a growth rate of 10 to 15% of earnings. So the biggest challenge, believe it or not, with an ESOP is that the value of the business, because the business doesn't pay taxes, if you have a 25% margin business, right, and you don't pay taxes, every 5 to 6 years, that 25% margin business is going to double in value. So if you go out 15 years, you could have a business that's worth 50 million today and then be worth 150 million in 10 to 15 years. So the biggest challenge with the ESOP is managing the wealth creation so that you can pay employees out of the business. The other thing that I like to do is I like to combine my ESOP with a 401k plan, because now you have three sleeves. You have the ESOP, you have your 401k, and then you have your traditional match, or what we call safe harbor contribution with the ESOP that might allow for employees to maximize what they can put in as a 401k contribution to a plan, which currently is about $18,500. If you're over age 50, you could put in an extra $6,000 into a 401k. So I tend to build my ESOPs inside the 401k plan because it's more efficient from a tax point of view to do it that way. The other thing with an ESOP, you could also offer a pension plan as well with an ESOP company. And a lot of people have a negative perception of pension plans, but if you have 100% employee ownership, guess what? Your stakeholders, your employees, why not have a pension plan and offer employees a tax protected and bankruptcy-proof structure with PBGC insurance on the company. So when you have an S corporation, there are special rules. One rule is you have a 100 shareholder rule. An ESOP is treated as one shareholder. So if the ESOP owns 100% of the company, then technically you don't have a problem with the 100 shareholder rule. The law, as I mentioned before, was changed in 1998 to basically eliminate taxation, and that's what UBIT stands for. So there is no taxation on the trust if it's to the extent that the ESOP owns the business. A lot of people ask me, do you think it makes sense to do a partial ESOP? And I guess you can do it. My concern with a partial ESOP is that you're now going to have taxation to the non-ESOP shareholders and no taxation to the ESOP shareholders, and that gets a little weird sometimes, and you tend to have the same complexity. So a lot of times I tend to do 100% ESOPs, but there are many partial ESOPs that are put in place in the market. So, one of the things that people ask me a lot is, well, what is an ESOP? And, well, basically it's a qualified plan, and it has to meet all the same rules that qualified plans have to meet: eligibility, coverage, non-discrimination, vesting, and other qualified plan benefits. So an ESOP can have one or two vesting schedules. You could have a 3-year 100% vesting schedule, or you can have a graded schedule with 20% beginning after 2 years and then 20% vesting each year thereafter, with 100% vesting by year 6. The things that are unique for an ESOP compared to another qualified plan is that an ESOP has to invest what's called qualifying employer securities. If it's an S corporation, you only have one class of stock with an S corporation, so that's your that's your qualifying employer security. If it's a public company, the stock has to be a stock with the greatest combination of dividend and voting rights. One of the things in a private ESOP that people get concerned about is, what is the voting rights? Am I, if the employee is going to be now running the company? And the answer is no. There's only pass-through voting on certain issues, such as a recapitalization or a sale of assets of the business. Generally speaking, you have a management team that runs the company, and you have a board of directors that oversees the company. So a business owner that sells to an ESOP can technically still run the company, but there will be oversight of the board. And then usually when you have an ESOP, you have one independent board member. There is an ability with an ESOP for diversification of 25% of their account balance at age 55 and 10 years of participation. With a private company ESOP, there's a right, what's called a put option, to receive your distributions in cash instead of stock. And there are special rules on timing for termination, retirement, death, or disability. Generally speaking, most ESOPs either provide a lump sum benefit or an installment benefit over 5 years. And if the account balance is over a certain amount, there is an ability to add a year for large balances. But generally speaking, people get lump sum or a 5-year installment from an ESOP. The other beauty about an ESOP is that it can borrow to buy the company. And there's 2 ways to borrow. One is the ESOP can borrow or the company can borrow. And many times, you have the company borrowing, and then there's a loan between the company and the ESOP. In many instances, the amount borrowed may differ. The terms of the loan may differ between the company and the ESOP, or the company and a third-party lender. So the other thing with an S corporation that you need to understand is that the tax benefits are fantastic, but you can't design the ESOP to benefit certain folks. So generally speaking, and I'm not going to go through these anti-abuse rules other than to say that if you violate them, you lose your tax benefits. There's an excise tax. It's like a nuclear bomb going off. But generally speaking, an owner that sells to an ESOP can participate in the ESOP up to 49% of the ESOP's value. And obviously it's going to differ from case to case. I've had instances where the business owner got a ratable ownership stake. I've had other instances where the business owner got a substantial take via the ESOP. But the important thing to understand is these are not tax shelters. There are rules in place to make sure that employees get a material benefit via the ESOP. The other thing I mentioned before to you was that the biggest challenge with an ESOP is the wealth creation. So, and that's what's called a repurchase obligation. And there's many ways to cover repurchase obligation. One is out of the cash flow of the business. Another way is pre-funding or shifting cash into the ESOP. Another way is debt. Some people use insurance to assist on either the former business owners or insurance on the participants. That's called corporate-owned life insurance. What I tend to do a lot with ESOPs is I put pension plans inside an ESOP to help manage the repurchase obligation, which just really creates a shift of value from the stock to a pension benefit. And there are other ways that folks use. But again, the biggest challenge with the ESOP is the repurchase obligation. What's that saying? It's good news, bad news. The good news is you've created incredible wealth for your workers. The bad news is you have to figure out how to fund that and pay that off. So I don't think it's bad news. I think it's good news. But you have to make sure you model it and make sure you properly plan for it. So what does this look like after the ESOP owns the company? And here's an instance of 100% employee ownership in this slide. You do have, generally speaking, it makes sense to have an outside independent trustee that oversees the ESOP. And, their role is primarily to make sure that the ESOP paid fair value for the company. Also, their role is to make sure people get paid when they're supposed to get paid and that the company is properly valued from year to year. We normally bring in an independent trustee at the initial transaction and keep the independent trustee on. Although you can have trustee committees, you just have to make sure there's no conflicts of interest. The ESOP then would own the company. You have an outside board of directors, which can consist of the former owner. It can consist of a management team. And the Department of Labor tends to like bringing in an independent board member on the board of directors. The board really oversees the running of the company. The CEO runs the company. The board can hire and fire management. The trustee can fire the board, and the board can fire the trustee. It's kind of a weird relationship, but usually the trustee doesn't get involved with the management. They let the board oversee the running of the company. The only time the trustee might get involved if there's some, proper accounting, or if the company ends up in a newspaper, or there's some kind of fraud or something like that. But generally, the trustee just wants to make sure there's an active board, and the board is monitoring the operations of the company, and it runs pretty. 99% of the time, there are no issues between the trustee and the board. It only becomes an issue if the company's starting to sink or there becomes problems. And then you have the, say, seller notes, and then you could have outside lenders to the company because this is a buyout like any other buyout. And I like to call ESOPs, private equity on steroids, because if you understand private equity buys companies with capital and debt, and they use the cash flow of the business to pay off that capital and debt. The beauty about an ESOP, it's the same approach. The only difference is the business doesn't pay taxes, and 40% of the profits aren't going to a third party. It's going to the employees of the company.
John, we have 15 minutes left.
Okay, great. Thanks very much. So what I'll do is I'll go through the next few slides. If there are any questions that come in, we'll certainly respond to them, and then we'll leave a little time at the end to respond to any questions that people may have. So the next question a business owner usually asks is, well, what is the valuation of my company? And I had used an example before of a company earning $10 million and being valued at $50 million, and 5x multiple of earnings. And that's what's called a discounted cash flow methodology. And I would say 80% of the time, that's going to be the method that's used. Valuation, and I'm not a valuation expert, but I know enough to be dangerous. The valuation folks usually use the discounted cash flow. They generally look at public company comparables. So if public companies are trading at a very high multiple, that could be a factor that's used in the valuation. You could also have guideline transactions or liquidation value. What I find most of the time is that the valuation can be a combination of the discounted cash flow and maybe assets on the balance sheet that the company may have, whether it be inventory or plant and equipment. So those are things that add to value. But most of the time, it's a discounted cash flow that's used. And it's really important when you do an ESOP to put together projections and getting a proper advisor to look at the value of the company before you enter into this process. So the next thing I'd like to talk about is, who are the players that are involved? So usually the company hires an accountant or consultant to, help them put together what I call a micro feasibility analysis, maybe design the ESOP and manage the ESOP implementation. If one of the more important things is what is the value of my business. So the company would also bring in a financial advisor to give them an idea of what if the company were to be sold, what the valuation would be, what does this look like in 5 or 10 years or 20 years, help raise financing and assist in negotiation of the ESOP transaction. You always need a legal counsel as part of this process. I like to get legal counsel early on in case there's some structuring issues with the company for taxation purposes, and make sure all the corporate documents are in order, and there's no surprises. The last thing you want to do is start going down a road and then find out there are major legal issues where the company can't be sold. So it's always good to have, the right folks early on. The truth of the matter is usually legal work is more heavier towards as you get closer to the transaction, but you do want the legal advisor with the consultant or accountant in the beginning. And usually a consultant gets hired right away. The financial advisor comes in pretty quickly too. And then I always like to get the legal counsel retained so that you have a team in place. Once you're comfortable that the ESOP makes sense, then the company would hire a trustee or interview a number of trustees. The trustee then would hire their own valuation firm and their own legal advisor. The company pays for those fees in order to do the transaction. And then in rare instances, if you have different selling shareholders, sometimes they may have their own financial advisor, accountant, and legal counsel. 9 times out of 10, it's really the first 2 columns. The shareholders are usually represented by the company professionals, and there's no need to have a third set of advisors. But it does happen in certain instances. So at this point, what I'll do is open up the floor. I kind of I think we read like the 37-minute mark here. I figured leave a few minutes for any questions of anybody online that if they have any questions to ask. I don't know if any questions have come in, Virginia.
No questions have come in yet. But like John said, if anybody has any questions, please you can go ahead and type in the box, and I'll read them out to John. But while we wait for questions, John, would you mind advancing to the next slide? I have some announcements.
Oh, I went the wrong way.
That's
Sorry
okay.
about that.
Okay, so we want to let everybody know, please save the date. We will be hosting a webinar on September 26th. This is creating an ownership culture with Corey Rosen from the National Center for Employee Ownership. And then we have one other save the date. John, if you wouldn't mind going on to the next slide.
Sure.
And we want to let everybody know that the Rutgers, New Jersey, New York Center for Employee Ownership, we will be having our 2nd annual conference on employee stock ownership plans and equity compensation on October 26th. This is at the Heldrich in New Brunswick. So stay tuned. More information coming soon with registration information. This is going to be a great day of information sharing and networking opportunities. And John is one of our speakers. So we're very excited about this. And John, we have a question right now. So I'm going to go ahead and read that. The question is, how do you value the owner's IP, and how do you establish a value if it is acquired by the ESOP?
Well, when you IP, I assume is intellectual property. Is that IP? I'm not sure what IP stands for. Could that person clarify what IP means?
Okay, I'll read the response once it comes through.
But generally speaking, it's, a business is valued several different ways. It's valued on the cash flow, the earnings. It's valued based against benchmarks of other companies or transactions that may have happened.
Yes, it's intellectual property is what he's
okay, so again, I think the intellectual property would be looking at other similar companies that have been sold in that particular space. So, and that would certainly be a factor in the valuation, particularly with technology companies. Normally, to be quite candid, normally ESOP transactions are valued, say, between 5 times earnings and 8 times earnings. And we've had some ESOPs go up to 10 or 12 multiple, and it may be in a technology space where there is intellectual property or software. And again, in those type of transactions, you're really looking at benchmarking against, say, public companies. But the most important figure is the earnings on the business. So that is probably one of the bigger factors in coming up with the valuation.
Okay, great. Thank you. It doesn't look like we have any other questions. Oh, we have one more, just came in. Okay, besides EBITDA amount and age of the owners, what is the profile for a company that is a good candidate to consider ESOP? Industry, number of employees, geography, etc.
Well, I don't think geography matters. I think what we find is there's a lot of ESOPs represented in a lot of different industries. Ironically, the biggest industry is manufacturing. The second biggest is service businesses. Engineering firms are great. Any kind of business that doesn't have a lot of big tax write-offs that are big taxpayers really make a lot of sense. We find that it's across industries. I find that the minimum number of employees where it makes sense is 15 employees. There are ESOPs with 10,000 people. There are ESOPs with 100 people. It's all over the board. It really, the two most important factors that I look at is a growing, sustainable business. You want a good business. You don't want to put a bad business inside an ESOP. So a business that's profitable, that looks like it has a good growth trend, and not a lot of volatility. Now, if we've done ESOPs with very volatile businesses. The problem with a volatile business is that may lower the value, and you want to make sure that you don't create debt that can cause the business to go bankrupt. So if I have a volatile business, I might want to use less bank financing and more seller notes, and maybe stretch the seller notes over a longer period of time, just to give us cushion in case there is, a 40 or 50% drop in the revenue of the business. So, but most service businesses are always profitable. It's just that, they may be making less money. So that's why service businesses are great for ESOPs. But we've seen a ton of manufacturing and other companies. But the key factor is how much of a taxpayer is the business. If the business is a big taxpayer, then that's a great candidate, and it doesn't matter what industry they're in.
Okay, great.
The other question.
Oh, sorry.
No. The other question I tend to get is, why aren't there more? There's about 6,000 ESOPs in the country, and a question I always get is, why aren't there more of these? And the best answer I can come up with is that, you have as many new ESOPs as ESOPs that are being sold. So there's a lot of turnover, and that really has to do with the repurchase liability. What we find is that companies that grow a great deal, it might down the road sometimes to deal with the repurchase liability, the company gets sold to manage that. That's not all the cases, but and you're not really forced to sell the company unless you properly plan for the cash flow. But that's a common question that I get. Virginia, any other questions?
Yes, there is one more. How difficult, expensive is the process converting from C to S corporation? Is it what you recommend before ESOP is established?
Well, yes, and you obviously don't do that until you've made the decision to do an ESOP. You could still have an ESOP for a C corporation. The only difference is the business is taxable, and then you'll get deductions for the amounts that go into the ESOP. So there are a lot of C corporation ESOPs. I tend to do mostly S corporation ESOPs. It's not a difficult process to convert from a C to an S. It's a very simple election that is done. What's complicated is the process of deciding to do an ESOP and the execution of an ESOP. And, you know, when you deal with a lot of service providers, professionals, lawyers, valuation firms, accountants, you can run up substantial fees. But what we find is that if you were to sell your business to a third party, you're talking about the same amount, generally speaking, talking about the same amount of fees that if you were to hire an investment banker to sell your business. In some instances, we find that the ESOP, once put in place, the first 3 months of tax savings covers all of the implementation cost of doing an ESOP.
Great, thank you. These were all really great questions. And if anybody has any other questions, you can always send them over to me, and then I can forward them over to John. John, would you mind going to the next slide?
Sure.
So if anyone has any questions about the Rutgers, New Jersey, New York Center for Employee Ownership, please feel free to contact us. Here is our contact information. We are happy to hear from you. And then our next slide, John, if you don't mind. And this concludes today's webinar. John, thank you so much. This was very informative. It was a great presentation, and thank you to everyone who attended today. We hope that you enjoyed it. Yes, we just got a question about the copy of the slides. The webinar is being recorded, and a link to the recording will be sent to everybody by early next week. So thank you again for attending. We hope to see everybody in our future webinars, and we hope to see you at our conference on October 26th. For more information, please visit our website, ownership.rutgers.edu. And thank you.
Okay, thank you.